So coming up this Wednesday, the Supreme Court is going to rule on whether or not the Trump tariffs were legal. That's going to have major market implications. If the Supreme Court does in fact rule that they were illegal and Trump is not able to somehow reinstate them, I think this is what would play out. Assuming everything else being equal, I think equities would rally, operating costs would come down, profit margins would go up, investors would flock more towards businesses generating higher revenue. Number two, let's go to commodities. Industrial metals, my favorite. Due to the ease of restrictions and increased business activity, I think it would make sense for silver and copper to go up. Let's go to bonds. Without tariffs, I think there would be more of a risk-on environment. High-yielding bond prices would certainly go up. People would feel more confident in giving money to businesses that are not traditionally as safe and take on that risk in return for higher revenues. Now let's look at treasuries, specifically the short-term to medium-term, 2 to 10 years. These assets are traditionally safe havens, but given the fact that tariffs would be lifted, people would be more willing to take on higher risk. So you see money move from this market back into riskier assets. These prices would most likely drop. People start feeling more comfortable with taking on riskier assets. So you would certainly see money move out of this market and into equities. In terms of long-term treasuries, that's a different story. You'd have to take into effect way more factors. We're talking over 10 years. It'd be harder to predict. Now, if the Supreme Court somehow keeps the tariffs in place, or if Trump manages to legally keep the tariffs going, the inverse of what I just said would logically be true. Again, all things being equal. Next, let's move on to the Fed. The next Fed decision is happening on January 27th to 28th. As of January 10th, Kalshi has the odds of the Fed holding the rates at 97%. So if the rates remain where they are, which is 3.5 to 3.7%, we'd have to look at the guidance, aka the explanation as to why they're holding the rates and going forward what they think they're going to do throughout the year. Now, if they give a dovish explanation, meaning he thinks inflation is going to not be as sticky, start moving towards the Fed's intended goal of 2% inflation, as well as a job market that looks not as bad as we all thought, and the Fed says there's more room for cuts, we're going to see the markets rally, specifically equities. It would be a more risk-on environment, people moving out of safe haven assets, US treasuries, gold, moving back into growth stocks and high yield debt. If the guidance is hawkish, meaning they think it's going to be a little bit more gloomy, inflation is stickier or continues to possibly go up, and the labor market does not look so hot, and it doesn't seem likely that the Fed will be cutting too much, we could see the inverse of what I just laid out. And a final scenario is if it's some sort of a neutral or mixed guidance. Who knows? It could be a mix of both scenarios. But I guess we'll have to wait and see. We all know that Jerome Powell, the chairman of the Fed, is due to step down at some point this year. President Trump is supposed to select a new person who a lot of people think will be dovish. And if he is dovish, then I guess the dovish scenario is what the markets will most likely price in. And the third scenario I'm looking out for is geopolitical stuff. Of course, there's no real set date or timeline with this, but I guess it would just be a personal deadline for me. We're talking about obviously Venezuela recently, and Trump has been in the news talking about Greenland, taking Greenland, or issuing warnings to Colombia being next. This is a very wild card scenario. Of course, we know Middle East tensions may rise again. China and Taiwan, that's a whole nother thing. Russia and Ukraine is unresolved too. It's ongoing. So if things heat up in terms of tensions overseas, that probably bodes well for safe haven scenario. And that specifically for me is going to be gold. But yeah, I think that's something that really we have to consider. That's not nothing. You would see a reversal in terms of money moving out of equities and a flight to safety, essentially. Long-term U.S. treasuries, gold, and maybe certain other currencies overseas that tend to do well. So recently I sold off some of the positions that I had in silver and copper and gold, and right now I want to keep some cash on the sideline until we get some more clarity around the following.